Good afternoon, guys. It's Saturday, May 28th. My name is Dave Croker, and this is, of course, Talking About Finance, where we talk about finance. And I can't help myself. I'm so fascinated with finance. Ever since it helped me achieve financial independence way back in 2002, I felt like carrying the message to people. So me and my friends, about 40 of us, maybe 45 now, on the Telegram channel, everybody's with a strong banking background. All we do is we exchange ideas, thoughts, GIFs, memes, whatever you want to call it, all day long, 24/7. So let's start out. Now, normally we look at year-to-date performance of the S&P 500 here, but with Friday's close, the S&P 500 broke its 7-week losing streak. My gosh, and I'm tickled. I just had to point that out. So let's see. The S&P 500 is up about 6.6% on the week. Now it's only down about 12.8% year-to-date. Keep the faith, my friends. The VIX traded by closing down this week to 25.72. These are levels that we last saw in May 4th or perhaps March 17th. The 10-year note closed down this week at 2.74%. It's up 1.2% year to date. And remember the relationship. As yields on risk-free securities, treasuries, increase, stocks are rendered less attractive. So very good we're seeing this yield fall. It's actually interesting. Oil closed this week at 115.13. Pay attention to 130. Remember, Goldman called it a recession indicator if it breaches 130 per barrel. It's up about 4.4% week on week, or about 53% year to date. So last week we talked about disappointing news from the retail segment. Target in particular got whacked and it dropped about 25%. My God. Imagine owning that thing, right? But let's step back from earnings for a second. It still seems there's good news about the U.S. economy. Job growth is solid. Inflation-adjusted consumer demand is still strong. People are depleting savings, running up credit card balances. Yes, but they're buying stuff. Demand is shifting away from goods to services. And we're seeing changes in the mix according to income. Higher income households still heavily weighed towards discretionary, while lower income households spending more on staples. And also last week, we got the Fed minutes from their May meeting. Now, they seem to be signaling, and maybe we're reading a little bit into it, and we're adding 2 and 2 and getting 5, maybe not. But in any case, we're of the consensus that the Fed seems to be signaling they might relent after 2 50 basis point hikes in June and July, respectively. Fed policy is still a key concern of investors, but as we talked about last week, Tina, there is no alternative to stocks at this point. Of course, I'm assuming you already got some bullion and perhaps some crypto. But regardless, I'll be buying stocks the first week of June because dividends are paid closing the month of May out. And yeah, just to close it off, right? I bought Bitcoin yesterday as I do every week. I've been doing so for years. I bought Ripple another 4 days last week, and I'll buy more tonight. I remember once a boss of mine at Deutsche Bank shouted down a graduate trainee we had on the trading desk. He cited uncertainty in the markets as a reason not to invest. Now, my boss at the time was a screamer, had a real explosive temper. They heard him all over the trading floor as he shouted out, as he screamed, "Just buy the effing stock!" When have times never been uncertain? Indeed. And that's why we have to invest. We've got nothing else that we can do to build wealth. Regardless, we see that smart money, the smart money index on Bloomberg, is trending down. And of course, this is a really interesting indicator. It's about 50-50. Don't panic. It's about 50-50 in its predictive power. But we see smart money, institutional investors, people like that exiting the market as retail moves in and perhaps, as I mentioned there, burns. But still, you have to be in this game to win this game. And one of the reasons why I always advise people to stay fully invested at all times, don't try to trade. You can't do it. Stay fully invested. Interesting chart. Not quite sure where it came from. One of the banks. Not totally sure. Research firms. I'm not totally sure. But regardless, we've got 2 lines, green, and I guess that would be fuchsia or pink. I don't know. My eyes are messed up. I'll just call it red. And what we're doing is we're taking a look at people who try to time the market, who try to ease in after we see the market rebooming after a sell-off, and we see people that actually hold the market all the time. And you can see the outperformance over a 10-year period. It's absolutely incredible. So yeah, Just buy and hold. Don't try to time the market. Don't get creative and try to sell. You're not going to do it. You're not going to be able to do it. Regardless, it's interesting to look back at prior bear markets. And if we look at the 73, 74 bear market, now, I wasn't really heavily invested in stocks at that point. I was still relatively young in high school. Had a few stocks, but not that many. Interesting, though, I do remember. And check this out. During this period, you're actually better off when there was a bear market rally, as we call it. They're calling it a rip here. You're better off selling into it. And of course, that was a pretty nasty bear market, guys. That was down almost 45%, I think, at its worst, its maximum drawdown, as we call it. Interesting. I'm not suggesting we're going into one now, but if you feel, in your own view, yeah, if you've got some stuff, you made some money, you might want to dump it at these rips. Personally, I don't do this stuff because I only buy cash flow generating assets. And here's an interesting one. Here we've got the MSCI World Index without America. And what we're doing is we're looking at the performance of global stock markets, both developed and developing, but ex-USA, not including the United States. And you can see every time there's been a sharp drop, there's been a bailout, and stocks rebounded. And now we're moving into this period of record tightening. Key question is there going to be another bailout? I'm of the mind, even before last week's minutes, that the Fed wouldn't let the stock market totally collapse. Keep in mind, there's about 18,000 boomers, baby boomers, retiring every day in the United States, and they depend upon stocks, investments that they built up over 20, 30, 40 years as a key part of the retirement plan. So they're absolutely not going to let that stock market melt. It just is not going to happen. They'll let inflation run hot before they let that stock market totally collapse. And by hot, I mean, I'm seeing some stuff that says that inflation might be running 4 to 6% over the next decade, instead of what we've seen over the prior decade, sub 2%. Interesting. Now, we have to look back. To learn about the markets, we have to look back in time. And here's an interesting chart that one of my friends put up. I'm not sure where she got it from, but what we're doing is we're looking at the Dow, and we're looking around the time of the Great Crash, and we're looking at the rallies that occurred. And again, if you are trying to time the market, if you're trying to trade the market, take a look at this and read it. Read into it and try to understand what's going on. If you want to get a good book to read about it, John Kenneth Galbraith's The Great Crash in 1929. I've read it 5 times. Classic book, my God. Really interesting. And you can see these rallies. You can see these big rallies that they had in relatively short periods of time. Look at what happened in 31. They had a rally that over the horizon had returned 1,355%, 56% annualized. Before that, we saw almost 80% annualized. So yeah, it's always interesting to look back and think about this stuff. I don't trade like this. I only trade for cash flow, or invest for cash flow, I should say. So this type of stuff is not really applicable to me. But it's interesting to look at this stuff. And regardless, you do have to pay attention to what's going on with the macro condition, with the money, in other words. And this is interesting. Now, I've shared with you guys before, I lived in Africa for many years, sub-Saharan Africa, mostly Nigeria, but also worked over in Ghana for a while. Togo, got caught in a coup. Wonderful continent. I really liked the countries that I was in. Lived in Egypt for many years as well, mostly in Cairo. And yeah, somebody sent this to me because they know I lived in Africa. Now, the thing that's funny here is not that there's a note down there in Zimbabwe for $10 billion, but it's almost like one of those prisoners. They're stamping the notes. Buy Bitcoin, please. Buy Bitcoin, right? Yeah, they don't like the money too much. They don't like their own sovereign currency so much. And they're recommending we go into Bitcoin. And here's an interesting one. JP Morgan in 2017 really dissed Bitcoin in a major way. And I saved this. I posted it on my blog, FinTech Flash News at the time. Couldn't believe he said this. Couldn't believe he said it was worse than tulip bulbs. Couldn't believe it wouldn't end well and someone was going to get killed. Now, at the same time that he said this, I am aware, and many other people in the Bitcoin community, the crypto community, were aware that JP Morgan was actively recruiting to build up a cryptocurrency capability. And look how the tune changed, right? This is September 12th, 2017. And right here, Thursday, May 25th, 2022. suggests, the research there suggests that Bitcoin's fair value is $38,000, 28% upside ahead. And that's okay. I like that. That's pretty cool because I'm still buying Bitcoin every day. I don't no problem with 38,000 as opposed to 29,000. But the thing that's really wild is look at this note down at the bottom that they will be replacing real estate with cryptocurrencies as their preferred alternative asset. My God. That's epic. That's really huge. And I did put this on the blog as well, FinTech Flash News, if you want to read the note. Really, really wild that they're actually suggesting that cryptocurrencies are a better alternative asset than property. I've got a lot of property, guys. I don't know if I'd go this far, but it's really interesting. Perhaps if I was younger, if I was in my 20s and 30s and still had the choice between building out a property business or going heavily, much more heavily than I am now in crypto. Wow, wild stuff. We'll have to think about all this stuff. But Bitcoin is going to be with us for a long, long time. And people that think it's going to go away really aren't paying attention to the past. What we've got here is we've got a nice chart of Bitcoin. We're going back to 2011. We're looking at the 4 epochs. Remember, we talked about this before. Periods where Bitcoin halves. And just, again, to refresh your memory, although I'm sure you're aware, every 4 years, every 210,000 block cycles, the production rate, the mining rate of Bitcoin is cut by 50%. We call this the halving. Now, a key takeaway, something that's really cool about this when you look at this chart, is that for every period that follows a prior period, the low is never below the all-time high for the prior period. So just take a look at previous all-time high and look at where we ended up in the next period. And yeah, the technical line is 19,744 for Bitcoin. If it breaks that rule, I think we'll be in trouble. Not quite sure what it means at that point, but I'm not really convinced we're going to get there. Myself, I'm buying Bitcoin every Friday. I've been doing that for years. I'm not changing. I do dollar cost averaging. I put the same amount of money into Bitcoin every week. Now watch, hold on. I didn't say I buy 1 Bitcoin every week. I've actually gotten people say, oh, you're full of it. Buying 1 Bitcoin every week. You're lying. I don't buy 1 Bitcoin every week. Keep in mind, 1 Bitcoin is divisible into 100 million Satoshis. Just like the pound is divisible into 100 pence. The dollar is 100 cents. 1 Bitcoin, 100 million Satoshis. So you can buy relatively small amounts of Bitcoin, relatively modest sums. The important thing to do, guys, is to engage in dollar cost averaging. I can't talk, right? Decide upon a sum that you can stick to and just invest that or purchase that. I won't say investment for Bitcoin. Use the same amount of money every week to buy Bitcoin. It's the only way to be sure. You can't move a whole bunch of money in at one shot. All right, guys, that's it. Thank you so much for your time. It's going to be a wonderful week. We're all excited because of what happened in the States with the S&P 500 last week. Let's keep the momentum up. First week of June, I'll be buying stocks. Hope you'll be buying stocks too. Take care, guys. Oh yeah, good music. Back in the 80s, my God.